Good morning, guys. Mark, not every internet-connected stock is doing well on this news. Some stay-at-home names I have my eye on are down a bit this morning. Zoom down around 3.5%. Chegg also down about that much. How do you expect this phase of having vaccines ramping is going to affect tech?
I think it's going to be a bifurcated impact on tech. So the stay-at-home names, and I would throw in there the Etsy's, Netflix's, Shopify's, Amazon's of the world. They're going to face pressure. But, you know, what I find interesting in the trading action today is that the impact isn't anywhere near as severe as what we had a week ago. And now I think the market's going to look through and try to decide which of the COVID winners is actually doing something structurally different, that they took advantage of this opportunity and they created either new business drivers or infrastructure improvements like Amazon with logistics to set themselves better up for 21 and 22. Then people will also still, though, look for those recovery plays. And in the consumer internet space, it's very clear. You get your Uber and Lyft's biggest recovery plays out there, and then the travel names, Bookings and Expedia, and all these companies are going to be presenting at our conference this week. That's my plug.
All right. All right. Jethro, you say the economy and markets remain levered to a heavily weighted technology sector. So what are you doing positioning-wise here heading into the end of this year, beginning of next?
Thanks for having me on the show. Certainly when you look at tech, I mean, the weighting of technology within the S&P still remains quite substantial. I mean, if you break it down, the IT service component is 26%. Communication services is another 15%. So that's 40% of the S&P, which has been, accountable for a lot of the big swings in profits. If you look at it from sort of an S&P 500 total perspective, for example, operating margins for the S&P is 11%. But if you exclude technology, it's more like 10%. And for tech, the operating margins are more like 22%. So that's going to remain a pretty significant factor. I mean, as far as what we've been doing, we have been overweight growth early in the year to a large extent. As growth has significantly outperformed some of these more cyclical value names, we pulled that back a bit. We maintain a net long position within the space, although, like I said, we've kind of reduced that. I mean, if you look at tech, for example, in terms of what we'd be doing within tech, we've been increasingly kind of taking a more barbell approach with some of the value-oriented names. If you think about hardware, some of the cheap IT and cyclical semis, while also maintaining some exposure to some of the secular growth stories. Think about 5G, the digitization of everything, and cloud, some of the cloud and SaaS names. Yes, they've gotten pretty stretched on valuations, and some of that's come off a bit. I mean, last week we had a 7+ standard deviation event in terms of a migration from some of these momentum names and some of these value names. But the growth stories, even though some of it got pulled in because of the pandemic, it's still going to play out in the long term.
Shepard Smith here. Thanks for watching CNBC on YouTube.